Mr. Richard, I granted you access for recording.
Yeah, I'm recording.
Okay. All right. Okay, sure. Okay, so what's risk and what's uncertainty? Or are they the same thing?
No, they are not.
Okay.
Risk, predicting the future when you have past information. Uncertainty, without any prior information.
Okay, so that's basically it. A risky situation is one in which there's past information, so we can assign probabilities to a situation where there are multiple possible future outcomes, and because of the availability of past information, we can assign probabilities and so predict the future with some level of certainty.
So are we defining Brian?
I didn't hear you.
Are we writing anything?
Mm-hmm.
Okay, so let's write.
Okay.
And I'm afraid, is that you or your daughter on that display?
Hello?
And I'm afraid, I said, is that you or
Yes.
your
It's me, old time pictures. It's not long ago. I think that's my ID, my Google ID. I logged on or I registered Zoom with my Google
Okay.
account here. I'm not just so ready for the lecture, so I decided to go off video.
This one that Brian is just forcing us.
No, it's good though. It's good. It's necessary.
Sorry, you. Okay, so a risky situation. So first of all, I'll rather define uncertainty first, so that it will take us to where we're going to. So uncertainty now.
A risky situation.
Okay, yeah, okay, so we can do risk first. Let's do risk first. Okay, so risk.
I thought we were detecting already.
Okay, so the issues with it are we have multiple future outcomes. And then because of availability of past information, we can assign probabilities
Should we write them as points?
No, you can just write them as one sentence if you want.
Okay.
And so,
sorry, you said multiple future outcomes.
Yes,
available for past.
So I said availability of past information. So I'm writing my own as point. So the idea is that a situation where there are multiple future outcomes where there are multiple future outcomes, and then there's availability of past information so that we can assign probabilities and predict the future with some level of confidence.
Confidence. Can we call that confidence setting?
Yeah, with some degree of certainty, with some level of certainty, yes. So the important things here are assigning probabilities. We're able to assign probabilities in a risky situation. Now, for uncertainty, on the other hand, so for uncertainty, also a situation with multiple future outcomes or multiple possible future outcomes. But in the case of uncertainty, no available information, so no means of predicting the future. With any level of confidence. So that's the difference between both of them. So where we have past information, that's a risky situation. And I remember I gave an example some time back about rain and whether rain will fall tomorrow. Is that a situation of risk or uncertainty?
After you said that. Rain fell the next day after you said that.
Are you serious? So I beg, I shouldn't say that again. No, I don't want rain now. Okay, so this a situation where we can predict the future is a risky situation. And please, it's important to remember that risk is not necessarily downside risk. Risk doesn't necessarily mean something bad, negative will happen. There's also upside risk. The idea is we don't know what will happen. That's why we say there are multiple possible future outcomes. So let me put multiple possible future outcomes, just like I put with uncertainty. It's not that doesn't portend any situation because I already know. So it's not about negativity. It's about whether I know or whether there are possibilities that it might be one way or another. So when we talk about risk, people generally think about risk as being a negative situation. That is downside risk. However, we can understand why we consider downside risk because downside risk is the one you're most afraid of. Upside risk, however, is a situation where I'm expecting something and something better happens. And that is still a situation of risk. Do we get the point?
We are out of time.
Yeah, we're out of time. So please, to just log us out and then we'll log back in. Uncertainty. One of the last thing I want to say, in a risky situation, we have multiple possible outcomes, but we have some predictive ability because there is a presence of past information. While with uncertainty, there is none. There's no presence of past information, so we can't make any prediction with any level of confidence. Now, we're going to look at the ways of incorporating risk and uncertainty. In investment, if you will, investment decision making or in investment appraisal process. So this is one of the questions that is very regularly asked. So one of them is using expected values / probability analysis. Another one, I think it's quite early to do this, but one other one is using sensitivity analysis. We can also use simulation. Yeah. We'll look at other things as we go forward. Now, let me just give a very general statement about this, and I would like to incorporate this as something I want you to make notes on so that we don't spend time on it, so that we're able to do what we have to do today. Now, with expected values. Okay, so I'll still incorporate the other one. So expected value. Expected value is probability of an outcome. Okay, the summation okay, that's going to be very difficult for me now. I don't know where to find summation.
The summation sign. It's going to be in
Yeah, the summation sign. I have to go and now find it in. Okay, so let me just do that. I think that is somewhere. I've used it recently. Okay, now is the summation of probability multiplied by the value of an outcome. So the summation of probability multiplied by value of each outcome. And we'll see how this works very shortly.
Hey, Brian.
Yes, please.
In the ways of incorporating risk, is risk adjustment discount rate included?
Yeah, we can adjust our discount rate, yes. So let me put adjusted discount rate. Okay, thank you.
You're welcome.
Okay, now expected value is the probability of a particular outcome multiplied by the value of that outcome will give us the expected value for that particular outcome. Now, expected value is one way of incorporating risk. Probability analysis is basically using probabilities, like the question we're going to look at now. So practically, what I'll ask you to do is, let me reduce the amount of time we're going to spend on things and just make it a little interactive. You can go on really any platform, including maybe you can even Google it and make notes on the following, on these four. So let me just explain them generally. With probability analysis, what we're doing is assigning probabilities based on different potential outcomes. It might be that for a particular situation that's going to happen in the future, we make assumptions that there might either be a good, a moderate, or a bad outcome. So maybe wanted to launch a particular product, and we say, what's the probability of the sales being very good? And then we assign a particular number, so that will be the value of the outcome. And then we assign a probability. So the sales being maybe more than 1 million in number will be maybe 30%. And then the sales being between 500,000 and 1 million, which we will say maybe will be a moderate sales, will be maybe 40% or 50%. And then the sales being less than 500,000, then that's the probability there will be 20%. Now it's important, if you've seen, I used 30%, 50%, and 20%. One thing that is important for us to remember is that our probabilities will always sum up to 1, will always sum up to 100%. So I'm basically telling you what you're going to see when you're looking at, when you're trying to make notes on this. Now the second one, sensitivity analysis. What is important for me to say is that sensitivity analysis is not really a way of incorporating risk. It's not really a way of incorporating risk, because sensitivity analysis doesn't deal with probabilities. Do you get that?
Yeah.
Yeah, so strictly speaking, sensitivity analysis doesn't really incorporate risk because it doesn't assign probabilities. Now with sensitivity analysis, what happens is we keep all the factors constant, all other factors constant, and vary one factor. Now, when we talk about factors or project variable, let's use the ideal terminology. So we call that project variables. Project variables are the different inputs into our project. So, for example, yesterday when we were looking at our question, and today when we will look at the question, we can see different project variables. Project variables will be things like selling price, like variable cost, like fixed cost. So if we look back, I don't know if my screen is showing. So number of units is a project variable, selling price, variable cost, fixed cost, initial outlay, and our discount rate. All of these are project variables. And so what we are saying is that with sensitivity analysis, we keep all other factors constant and vary one factor and see how a variation in one factor will affect the outcome of that project. Now, the next thing we are going to do seriously, immediately after looking at MPView, if we remember even the outline we gave for the way we are going to work through, the next thing is sensitivity analysis. So we're going to look at sensitivity analysis, and we'll really do this practically, keeping all other factors constant and varying one project variable. and seeing how a variation in one project variable would affect our decision. Is that fine? Any question?
No.
Are you giving us a note? Are you giving us any note on sensitivity?
I said I want you to make notes on it.
And
you can actually cheat by using these discussions now to make your notes. That works for me.
Okay.
So since you're recording them, you can use this to make the notes. I just don't want to spend too much time on it. I'm bored to death.
Okay.
Because if I start dictating and copying this thing now, I'm just wasting time.
Okay.
As long as you get a clear or a basic understanding of what I'm saying, then you can easily make the notes out. You can go on Google or the textbook or whatever. Now the third method, the third way, and please remember the emphasis that sensitivity analysis, strictly speaking, is not a risk incorporating technique, because it doesn't use expected values, and that's the reason why, because it doesn't assign probabilities to the outcomes. Now with simulation, what happens with simulation is that, if you will, simulation. Yes.
Sorry. Yeah, if it is not actually a means of incorporating risk, then why do they include it as part of ways of incorporating risk?
If you remember the last thing I said that in practice, before we went off before, in practice, risk and uncertainty are used interchangeably. It might be a very good argument to say that sensitivity analysis incorporates uncertainty, but it doesn't incorporate risk, because it doesn't assign probabilities.
Okay.
All right. Now simulation. What happens in simulation is that, if you will, from the English word simulation, what we are trying to do is to simulate, so to make believe. So what we do in simulation is to create a number of different possible scenarios. Now with sensitivity analysis, we're keeping one factor constant. Sorry, we are varying one factor and keeping all the other factors constant. With simulation, what we do is to allow different scenarios where multiple factors will vary. Different kinds of things. So we're saying, so a great example is this period we are in now. Maybe 6 months ago, a company might have wanted to execute a project, and everything looks very, very, very good. They say, we're going to make a lot of money. Everything is good. They've predicted for weather, they've predicted for different things, but nobody would have, or if someone had said, let us also predict that something might happen, there might be a contagion in the world, and then business activity will shut down for a significant period of time. All those kind of things are things that you can do with simulation. So with simulation, you can incorporate different possibilities into different. No, it will save by itself.
Yeah, but mine it's converting.
Yeah, it takes a while to convert.
Mm.
So my problem is because I'm saving too many back to back.
Yeah, you have a heavy.
Sometimes it will corrupt.
Okay.
It will just corrupt. So some of the videos have not saved properly, and I don't know whether there will be a way to save them. So we'll see. I was looking at it day before yesterday, and it took me like 4 hours, and I didn't make any headway. So I'll still look at it again.
Well, Mr. Richard, what are you using to convert it?
There's an application that I'll convert with. I want to see if I can put them together. Let's just one straight thing so that I can send it to the group.
Wow. Thank you.
Okay then.
Okay, now, so simulation is just basically creating multiple scenarios using computer modeling and being able to incorporate the different expectations, the different possible expectations, and assigning probabilities based on the expectations. Now, the final one is an adjusted discount rate. Adjusted discount rate is quite simple. If you remember, we calculated our cost of capital and we used the beta. And we said with calculating our cost of equity and ultimately our weighted average cost of capital, we used beta. And we remember we did our project specific discount rate, right?
Mm-hmm.
Yeah.
Now,
Yeah.
the concept of that project specific discount rate is basically the concept of adjusting the discount rate. So an adjusted discount rate, if we feel like if this project is going to be more risky than our current activities, then we can increase the beta, just like we did when we are doing project specific discount rate. So that's basically the concept of adjusted discount rate. That's why, and it makes a lot of sense. So to be able to incorporate risk and uncertainty, we can adjust our discount rate to reflect whether we expect that this project will be more risky or less risky than our current operations. Do you get that? Okay. So that's basically it. So with expected values, assign probabilities, we can do a probability analysis for different scenarios that we expect. With sensitivity analysis, we keep all other factors constant and vary one project variable. So only one project variable and then keep others constant. With simulation, it's a lot more complicated with creating different scenarios and varying multiples, and then based on our expectations, we assign probabilities. And then with our adjusted discount rate, we adjust our discount rate either higher or lower to reflect expected risks with a particular project. Okay, so our expected value, we said expected value is probability multiplied by the value of outcome. So would sum all the probabilities times value to arrive at our expected value. Now let's look at the questions we discussed yesterday. I think one of them, oh sorry, the questions that we had sent earlier on had project E was later. Okay, so we have two of them here. VYXYN, right? And the other one, I liked the name. What's the name of that one again? VYXYN. VYXYN. I like VYXYN a lot. Okay, so okay, so let's look at VYXYN. VYXYN funny, really, really funny.
164, right?
164, yes.
Okay.
But please just look down. Look at the last part of the question. VYXYN 164. It's really interesting. And I honestly, I have not seen this. I didn't look at this before the class, but that's really funny. If you look at the part C, they said critically discuss how risk can be considered in the investment appraisal process for 8 marks.
That's a lot of marks.
Can you see that? That's a lot of marks, and that's basically.
So are we not going to talk of the expected value?
So that's
analysis,
basically the answer to the question is basically what we've just discussed over the last 15 or 20 minutes. That's just the answer. That's the 8 marks, really. Just in your own words. And so I've implored you, please. I've already set it up. If you actually, I don't have the textbook. You do. If you can actually copy the back of your revision kit now for the answer of this question and study it properly and remember my words with this recording, you're good. This is a very examinable question. It is very, very highly examinable. It's something that you cannot say you are surprised if you saw in the exam. Now, okay, if we go to, before we start our question, so we'll do VYXYN. I don't know if we have time, we can do VYXYN, but we'll do VYXYN definitely. If we go to number 163, VYXYN, if we go to VYXYN, we'll see that the part C of the question says, can you see part C? Part C says, critically discuss in assessing the risk of the investment project, and that was given 6 marks. So these 2 questions give you very good discussion on what we have just discussed. Basically, if you're looking at the answers at the back of the book, you'll basically be seeing exactly what I've said. So you'll be able to understand the answers very, very clearly now because you've had this discussion. So let me see whether that one has sensitivity analysis. No, it just says, okay, so the part B of that same question, of question 163, part B says, distinguish between risk and uncertainty and briefly explain why they should be considered in the investment appraisal process. So exactly what we've just discussed. So technically what we have been discussing all through the last few minutes is basically what they've asked us for. So he said, distinguish between risk and uncertainty. And our core distinction is availability of past information, right?
Yeah.
Yeah. Okay, so Khadija, are you here?
Yeah, Brian.
Okay, all right. Good afternoon. Sorry about the impromptu information.
It's okay.
All right. So let's look at VYXYN, right? So please, can someone read for us? Can someone please read for us?
That's 164.
Yes, 164.
Required. A, discuss the difference between risk and uncertainty in relation to investment appraisal. B, calculate the expected net present value of the investment project and comment on its financial acceptability and on the risks relating to variable cost. Then C, critically discuss how risks can be considered in the investment appraisal process. VYXYN, according to you, Co is evaluating a planned investment in a new product costing $20 million, payable at the start of the first year of operation. The product will be produced for 4 years, at the end of which production will cease. The investment projects will have a terminal value of 0. Financial information relating to the investment project is as follows. Year 1 to 4. Sales volume, selling price, fixed costs, figures as provided. These selling prices have not yet been adjusted for selling price inflation, which is expected to be 3.5% per year. The annual fixed costs are given above in nominal terms. Variable cost per unit depends on whether competition is maintained because suppliers of key components. The variable cost per unit depends on whether competition is maintained between suppliers of key components. The purchasing department has made the following forecasts: competition, strong, moderate, weak, probabilities, variable costs. The figures are given. The variable costs in this forecast are before taking account of variable cost inflation of 4.0 per year. VYXYN Co can claim tax allowable depreciation on a 25% per year reducing balance basis on the full investment cost of $20 million and pays incorporation tax of 28% per year 1 year in arrears. It is planned to finance the investment project with an issue of 8% loan note, redeemable in 10 years' time. VYXYN Co has a nominal after-tax weighted average cost of capital of 10%, a real after-tax weighted average cost of capital of 7%, and a cost of equity of 11%.
Okay. Okay, so a lot of interesting things that have been done for us here. So you see, one of the things I emphasized at the end of yesterday's class was the fact that they might give you both your real rate and your nominal rate.
Yeah.
And that's what has happened here. And I've seen people get stranded in the exam because of not being sure of whether to use the real rate or the nominal rate. And those are some of the things we are going to clear. Other things are really, really interesting question. A lot of twists and turns. Very, very solid. 9 marks only for the computation, so no big deal. There are some parts I really found interesting. I like the way they said that the fixed cost has been given to you in nominal terms. That's amazing. So they have already inflated it. So there's no, I would have been even more impressed if they could have told us, they would have given us the inflation value for the fixed cost, just to look for someone's trouble. Because if they tell you it's given to you in nominal terms, it means they have already inflated it. So there's no inflation to be done. Just copy and paste the figure. Then the whole idea is that our expected value, our probability analysis, the expected value is with variable cost. So it's only variable cost that we are incorporating risk and uncertainty into in the question. So just for variable cost. And so we're going to look at, they've given us probabilities. And like I was trying to explain, I think that it's when you're discussing, when you see real life questions that it even gives more understanding. So in this case now, they said that the variable cost will be dependent on competition between suppliers. And they said that there are 3 possibilities basically. There might be strong competition, there might be moderate competition, or there might be weak competition. Now there's a 45% probability that it will be strong, a 35% probability that it will be moderate, and a 20% probability that it will be weak. If we see, I said, as always, our probability will sum up to 1. So 45 plus 35 plus 20 is 100%, which is 1. And then they've given us 3 values for variable cost, for strong, moderate, and weak. So the first thing to do in the question is to do the working for what our expected value for variable cost will be. And really, that's why I said this is very simple. There's nothing more to it. Just what is the expected value for variable cost? And they told us our variable cost inflation will be at 4%. So we're going to inflate the variable cost after calculating the expected value by 4%. So this thing might look very I don't know what the word is. Very interesting, very like a lot of work. But once you've done it the first time, it's quite simple. It's not different from what we've done before. Then the other things that are complexities in the question are, they said tax allowable depreciation, 25% reducing balance basis, and you can claim it on the whole 20 million initial investment. And then they told us our tax rate is 28%. And then the loan note of 8% loan note for the project finance. Please be careful. That 8%, you have no single business with it. The 8% loan note and the cost of the loan note is already incorporated into your discount rate.
Yeah.
Just like we said before. So VYXYN Co has a nominal after-tax weighted average cost of capital of 10% and a real after-tax weighted average cost of capital of 7%, and cost of equity is 11%. So really interesting, I think. Okay. So which of these rates? They've given you 4 different rates now. Is that 4 rates? 4 different rates. Which rate are you going to choose? 8%, 10%, 7%, or 11%?
10%.
Just 10%. So this could have been a very, very big issue for someone writing the exam and not being clear about what rate to use. So many rates flying about. However, every other rate is irrelevant. All you need is your nominal after-tax cost of capital. That's all. Okay, so we are good to set up. It will log us off just as we are setting up, and then we will come back and do the question. Okay, so what I've also done, and I'm saving this now. Okay, I'm saving this from yesterday. So what I've done is to save. I will start. So every question we do now on Excel, even the Word, I will save both Excel and Word now. So it will be easy for me to transfer it at any given point. I can either transfer it as one time or transfer it over time. But all I want to do is, am I sharing my screen? Okay, let me share my screen instead so that you'll be able to see it as it comes up. So what we did yesterday is here. And why I feel this is more important, a picture is not very valuable because the picture, you can't click on it. Do you understand what I'm saying? With this Excel spread now, if you get the spread itself, then you can put your cursor on a figure and know how that figure was generated. So if I did this, then I can see it's E8. Can you see that? E8 multiplied by E6. So that would be more useful when you're doing your studying. So if you're using this, then you can actually, so without being confused, you can see where did you get each individual figure from. So what I'll do is I'll be saving this spreadsheet. I'll just add another, so I'll have sheet 2 now for the question we're doing and so on and so forth. So when we do sensitivity analysis, I'll do another one and so on and so forth. Okay. So just add a new one. And our question is VYXYN. Gertrude, you like the name, Abi?
Why are you saying that I like the name?
Because you are saying that me too, I like the name now.
No, as you said, that is what I said. I said I called the name, I said VYXYN according to you.
Because you took the verse.
Brian, you're looking for trouble now, no?
I'm looking for trouble.
Say, Mr.
I know that I'm
Richard,
looking for trouble.
Brian, is he looking for trouble? We can see.
Yeah, I know that I'm looking for trouble. Me too, I know, sir.
To class. Now and again, you're saying she to the vex.
Sorry, it's devil work. Me, I was even surprised when the thing came out from my mouth. I wanted to hold the mouth that, don't go and put yourself in trouble. So VYXYN. So this is, every time you see expected MPV, means that there's expected value in it. So normally they will say net present value. But once you see calculate the expected, so it means that you're doing probability analysis, you're doing an expected value. That's why that expected is there. Okay, so our first calculation. Okay, so we start our expected value of our variable cost per unit. So we have three of them. So maybe we should do that under. So for we have three. Yeah, that's usually that would be a reasonable place to start. Instead of doing that inside the computation, we can also make it work in something.
Okay.
I don't know which one pays us more. Anyhow you do it is very correct. So we have probability variable cost. So we have probability and value, Abi. So for the first one, so for strong, we have our probability is 0.45. And the value of that is 10.8, Abi.
Yeah.
Then for the second one,
35 moderate. That's 35%.
So the second one is 35%, so 0.35.
Then variable cost $12.
So the variable cost is 12%. And then for the last one is 20%, so 0.2.
Yeah. Variable
and
cost.
our variable cost is 14.7.
Yeah.
Okay, so we can get our expected value. So probability times expected value. Sorry, probability times value rather. So our probability times value will be equal to, so basically what we'll do is multiply them by each other. So the first one, the probability multiplied by our value, right?
By value, that's C6.
And then we can drag it for the three of them. So this implies now that our expected value will be equal to, then we can put it close. So I expect of them. So that's, sorry, the addition rather. So sum. So we can just sum it instead. The addition of three of them. And that's our value. So our value is 12. And that's all, nothing more. Is this fine?
Yes.
Hello. Yeah, please, Mr. Brown, can you? Okay, can you place your mouse on the first probability value?
On which one? The first one?
Probability value, yes, the one for strong. I just want to see what you did there.
Okay, so it was just probability multiplied by value. So it's
Okay.
C5 multiplied by C6.
Okay. And then the expected value, can you place it there?
Okay, the expected value is now addition of the three of them.
Of the three. Okay.
So the probability times value of each of them, three of them together will give you your expected value. Remember we said it's the summation of probability times value. So we did probability times value in each case, and then probability times value. Then the summation of the three of them is now our expected value. Okay, so with that, we can do our computation now. So basically, we would have, first of all, year.
So this first part is like
So
walking.
same thing. Yeah, it's just like working one. So instead of doing that, like someone asked, we could have instead just done, we would have put it as a working somewhere here, and then done our tax allowable depreciation too, because those are the two workings we are going to have. So anyhow you want to do it. So 0, 1, 2, 3, 4, and we are adding a fifth here because it's payable in our price. Our selling price, our inflation for selling
3.5, yeah.
Three point five.
So 3.5. So multiplied by 1.035 here. That's 26.5.
Yeah.
26.
So 26.5. So we can do, sorry. So is equal to 26.5 multiplied by inflation of 1.03. So that's all. Okay. Now the second year in the question, 28.5, right?
Yes.
So it's 28.5 multiplied by 1.035, and that one will now be raised to power 2. Okay. Then the third year, 30.
30.
So 30 multiplied by 1.035. Please be very careful when you're doing your calculation that you don't make a mistake and multiply by 1.35. 1.35 is 35%. Oh.
Yeah.
Just be careful. I know what I'm talking about. It might look like a dull statement now until you're doing it, and especially when you're doing it in the exam. So the last one is 26. So 26 multiplied by 1.035 raised to the power of 4. Hafsat, are you here?
Yes, I'm here.
Okay. All right, cool. All right. So the next thing to do, okay. So now variable cost per unit. So our variable cost per unit, we know is 12, Abi. We know it's 12,
Yes.
right?
12. Yes.
12. So please remember why you're doing what you're doing, because this is the interesting part. The 12 is the 12 we calculated. It's not in the question. It's the 12 we just calculated. So that's why we calculated that 12. So it's equal to 12. And they told us our inflation is what?
4%.
Was it 4%?
Variable
Yes.
cost.
Yeah, 4%.
0.
So 4%. So we can make our lives easy and say raised to power raised to power 1. Raised to power, we use the year so that we can just drag it, right? Okay, so can everybody, I know my internet just fluctuated now. So I hope everybody's seeing what we did.
Yeah.
Yeah, okay. So that's that. And then we're going back to the way we normally did it again. So I've said any way you want to do it is fine. So we can do our contribution per unit. So our contribution per unit will now be equal to the selling price minus our variable cost. And we get that figure, and we can drag it for all the years. And we're done with our contribution per unit. So now we get our sales volume. So our sales volume first year. So we'll do our sales volume, like I like to work in thousands.
Go 40.
Okay, so 440 next year.
550. 720.
Sorry. Okay, so
550.
550.
720.
720. Final year.
And 400.
400. Okay, so I don't like this 0.0 anything. Okay, now from here we can get our total contribution. Our total contribution, we can come here now, and is equal to this multiplied by that. So we get that figure. And so we can have it for all the years.
Brian, you didn't actually. Just expand.
Why am I having?
Expand. Just expand.
Sir?
Just expand the row. That's all. From the top. Grab from F on top.
Okay, thanks.
Pull it.
Yeah, I've done that. I've done that.
It's still not showing though. Okay.
And maybe I think my internet is slow. I can't hear you, Afsat. I can't hear you. What did you say?
I said book by
Mr. Richard, can you hear her?
I can't hear at all.
Okay. No, it's breaking. Okay, please just try after a while. I'll still come back. So fixed cost now.
Hear me now.
Yes, I can hear you now. I can hear you now.
I said the figure for growth per unit.
Oh.
It is terrible.
No, network is not good.
Or she should send a message.
Yeah, she can.
Okay, you can send a message. You can send a message in the worst case while he comes back up. I'm coming.
Oh,
just send a message. And after a while, I'm sure it will be better. Okay, so our fixed cost now. Our fixed cost.
$1,100, 1,221.
Okay, so our fixed cost now, we're picking all of them. Hafsat, if you can talk or you can send a message.
Okay.
Okay, so our fixed cost 1100. Then the next year
1121.
1121. Yeah, so we can see that there is an inflation for it. I think inflation is 5%. So 1155 and 1200. Okay, so that's that. What's next?
Mr. Brown.
Yes.
Yeah, I was that's different.
Sleep
Nothing is
can
coming
hear
out.
you. On variable cost.
Yes.
Okay, still variable cost.
Maybe she should change her position.
Okay,
Maybe she
Hafsat,
should
if you can hear
change her
me, please
position to maybe
change
to
your
look for where the
position.
network is.
Check the 5G place. Check the 5G place in your area. There's one place there in your house that is 5G. That 5G place. I'm not still hearing. It's unfortunate. But I placed my cursor on the variable cost, which is what I thought I had.
You come about
The 12 came from. I didn't hear you. Yeah.
Madam Hafsat, call Brian on phone.
No, but you can send a message. Send a message on the chat. In the interim, it will still come back on. It will still be stable after a while.
Okay.
Okay, so our variable cost was from the calculation we did for expected value. So if you will, we could have called that expected variable cost per unit, just to be clear that it was the expected value computation we did. Now our pre-tax operating cash flows, we can get those figures. So it's equal to the previous year or the total contribution minus our fixed cost, and we get that. And then we can drag for all the other years, and we can get our values. And now we have our tax. Our tax rate was what?
Tax is 28%.
So our 28%. So we know 1 year in arrears. So we can come here. So this will be equal to the previous year pre-tax operating cash flow multiplied by 0.28. Then the next year will still be equal to the previous year, so year 2 now, multiplied by 0.28. And then we'll go to the next one, is equal to the previous year multiplied by 0.28. And then we now have our final year, year 5. So that will be equal to the previous year's pre-tax operating cash flows multiplied by 0.28. And we're done with that. So we can make them negative figures. We're not comfortable with this. So we can go and put our negative there. I should have done that earlier. So negative. Okay. So the next thing to do now is our tax allowable depreciation, right?
Yeah.
Okay, so tax allowable depreciation, straightforward. We'll just do a walk-in for that. So we can come and do our walk-in here. So as always, and then we have our year. Then we have our opening. Then depreciation. Our depreciation rate was what?
25%.
So 25%. Then our closing. And then our tax allowable depreciation. So our tax allowable depreciation now will be
28%.
so depreciation times 28%, Abi.
Yeah.
Okay, so we good. So 1, 2, 3, 4. Okay. Then our opening now. Our opening is at 20 million, right?
Yes, that's 20,000.
So 20,000. And then our depreciation. So we said we can put 25%. So 0.25 and 0.28.
It's 16 hours.
You said what? So it's equal to that figure multiplied by 25%. Our closing now will be equal to this minus that. And then for the next year, same thing, is equal to the closing for the previous year. And then this will be equal to that multiplied that. And then this will be equal to this minus that. Same equal to this. This equal to that multiplied by that. And this is equal to this minus that. And then finally equal to the previous one. And then equal to this multiplied by that. And then That is equal to this minus that.
But is it wrong to approximate?
Is that?
Is it wrong to approximate?
No, I've even approximated it to one decimal place. There's no problem with approximating.
So without the decimal, making it a whole figure.
You can make it whole figure. You can make it whole figure. That's fine.
Okay.
Okay, so our tax allowable depreciation now is equal to this multiplied by, so we can do our dollar sign. So 28. So we can come so that we can make it absolute. And then we can come there and drag it down. And then we have our figures. So what did they say about scrap?
There was no scrap.
Zero, nothing. There's no scrap.
So our carrying value
Is greater than.
is that, and scrap is nil.
Yeah.
So carrying value greater than scrap. So that will imply a loss, right? So we have a loss. Are you back?
After, yes.
Yes, okay. You were asking something earlier on.
Yeah, I was asking the value for variable cost 12.48, and when we got the 12, we multiplied it by the inflation.
Exactly, by the inflation rate. So I can come back. Let me come back here and say multiplied by, because that's what we have been doing. That's our normal way. So multiplied by 1.04. It was 4%, right?
Yeah.
Okay,
4%.
so that's that. So raised to power n. Okay, so our allowance is our carrying value multiplied by our tax rate. And so we have those figures. So we are good to go. So we can come and our tax allowable depreciation for the working, we can pick all those figures. So it's equal to the first one, equal to the second one, then equal to the fourth one. And then we have our balancing allowance. So still working one. And then in the fifth year is equal to our computation for balancing allowance. Okay, so we're done. Okay, so after balancing allowance, what's the next thing? What's the next thing?
Initial outlay. No scrap.
So our initial outlay.
Yeah.
No scrap, no working capital. So initial outlay.
So no working cap. So we would have put initial outlay even before working capital. Okay, so we have our initial outlay. Of 20,000, right?
Yeah.
Okay, then no scrap, Abi. No scrap. So we can go straight to our free cash flows, right?
Yeah.
So our free cash flows, so is equal to, so we're summing, and all of them from our pre-tax operating cash flow down to there. Okay, so with that we can drag. Balancing our allowance was huge, so much so that we have a positive figure in year 5, which is very rare. So from there we can do our discount factor, and we agreed that our discount rate was what?
10%.
At 10%, Abi?
Yes.
Okay, so we now have, so our 10% will be 1, so it's equal to 1.1 raised to the power of, please never forget this minus, and then we pick our year so that it will work for us nicely. So that's the first, and then we can drag that, and we see figures we already are conversant with. Okay, so our present values now. So our present value equal to the free cash flow multiplied by our discount factor. And then with that, can drag again. And we're done. So our net present value now. So that will be equal to the sum of all of them, all the present values. And so what's the final thing? So what's left? We're on 8/9.
We have to comment.
Comment.
Okay, so therefore,
You have to write your decision.
what's your name? What's the name of the?
VYXYN,
What's the
according to
name?
you and Gertrude.
No. It's only one person that should talk. Oh yeah, tell us. What's the name?
VYXYN.
So, it is sweet for your mouth. Well.
Right.
It's played now. They don't used to play with you. Abba. And with that, we get our full marks. So that's that. Please, I've said this before. There's no single mark for formatting in the exam. So be careful not to waste unnecessary time on formatting. Okay, so that's our work done. So it was 9 marks. So our ultimate ambition will be, what's 1.8 now times 9? That's where the problem is. That's where the challenge, the real challenge and the hard work is. Our aim, or under exam condition, you're supposed to be doing this in less than 17 minutes. That's why my constant emphasis on be careful about wasting time on formatting or any other irrelevancies. This is a 17 minutes mark question. Of course, you'll be able to make up the marks to some extent. So what your target should be about 20 minutes, because the writing part, if you know it, then it shouldn't take you very much. You can pick up, you can do that very quickly so that you have some additional time for this. And really, as you continue practicing, objective shouldn't have taken you enough time so that you can spend so that you can have some allocation for this kind of things. However, we should try as much as possible to continue practicing these things so that you can be fast. Even the questions, even if it's just the questions we've done, that you can take time, be able to look at a question, appreciate what the question's requirement is quickly, and then work on it. Okay, any question? Adija is not here. Okay. Okay, so what do we do next?
Sensitivity analysis.
So sensitivity analysis.
Mhm.
Brian.
Yes.
Yeah, as in, apart from like the B aspects now, yes, on the financial acceptability, it's okay, we should accept it. Then how do you now like say, as in the risks relating to variable costs, how do you explain that?
Okay, so the risk relating to variable cost has been captured by the use of expected values. So the use of expected value in measuring the whether strong, moderate, or weak, or is that how they said this one?
Strong, moderate, and weak.
Strong, moderate, or weak has captured the potential possibilities, the potential possible outcomes in the future. So the use of expected value in measuring the different possible outcomes has captured the, so that would just be a one-line statement.
Okay.
So basically we've already done it with the expected value. So if I can go back.
Yeah, I understand. I just wanted to know, as in, how do you now, as in, explain that?
Yeah, so that's just basically it.
Yeah. Sorry, Brian.
Yes.
The balancing allowance, are you not supposed to multiply it by the tax rate?
I thought we did that. Yeah, we did that. That's how we got this figure. It's multiplied by the tax rate. The tax rate is 28%, right?
Okay.
So the carrying value, we multiply the carrying value by 28%.
Yeah. Sorry.
So that's our comment. You can be expected value as a the different possible. That's basically, that's all.
Mr. Brian.
And introduce maybe capital.
Yes.
Yes.
Okay.
Yes, I'm coming. Your assignment to please make notes on the following. And like I said, you have too many options of where to get the notes from, including the answers to the questions, to the two questions that we just looked at. So sensitivity analysis involves keeping all
Variable constants.
project variables constant and varying one of the project variables. No, I don't like the way I've said this. Let me restate it. So it involves varying one project variable whilst keeping all others constant. So the formula for sensitivity is equal to MPV divided by present value of project variable so it's the net present value divided by the PV of the project variable multiplied by 100. So for example, sensitivity to selling price Okay, so now let's start looking at the sensitivities. Let's not take this as example. Let's actually take it. Let's actually do our definitions or our description. MPV divided by present value of revenue. So it will be in total terms multiplied by 100. Sensitivity to variable cost will be equal to MPV divided by the present value of total variable cost, and that figure multiplied by 100. Sensitivity to sales volume is equal to MPV divided by total contribution. We can say that's exactly the same thing as saying MPV divided by our, that's present value, sorry, let me say that again. So that's present value of total contribution. So that's MPV divided by present value of revenue minus present value of total variable cost. I'll be too surprised if nobody has a question at this point.
What did I do?
And then I'm surprised though, sensitivity to fixed cost is MPV
Mr. Brian,
yes please.
why would I multiplying by 100?
Why we what?
Why would I multiply sensitivity to sales volume by 100? Why would I put it in
Okay, so
percentage? Is
yes,
that an error?
it's times 100.
Mr. Brian,
Yes, please.
what's the question we're supposed to ask?
How does sales volume and contribution? What's I don't understand that one.
How does sales volume?
Why are you using contribution for sales volume? You use revenue for selling price, makes sense. You use total variable cost for variable cost, makes sense. Then you now came to sales volume and used contribution.
Okay, so why is variable cost incorporated in this?
Not just variable cost, as in revenue and variable cost. It's contribution you're using for.
Why are we subtracting? Okay, so that's the question now. What are we supposed? Why is it this way?
Why are we using contribution?
Contribution,
to find sensitivity to variable cost.
To sales volume.
To sales volume.
Yeah.
And the reason really is because if we remember how we do our computation, we'll do selling price minus variable cost multiplied by sales volume to get our contribution. So the relationship sales volume is what relates selling price to variable cost, as in total revenue to contribution. Do you get what I'm saying? The sales volume affects both selling price and variable cost in the same way because the sales volume is constant. So to calculate our sensitivity to sales volume, we use contribution. Contribution being the number of units multiplied by both selling price and variable cost. It's just something I want you to remember because that's not the one that comes naturally. So if they were going to ask a question in the exam, many a time what they will ask you is sensitivity to sales volume, because it's very easy for someone to now start multiplying or start doing MPV divided by number of units, and that's not correct. It is MPV divided by your total contribution. So I want us to emphasize and not take it for granted.
Okay.
Now, the final thing I want us to, yeah, do you get my point?
Yes, I said thank you. Yeah.
Okay. Now, the final thing is sensitivity to discount rate. Now, I can go up in as something that I did not emphasize clearly was sensitivity measures how a change in a project variable would affect the net present value. So, in essence, if a project variable, or sorry, let me say that in another way. So by how much would a project variable change for MPV to become negative? For MPV, I'm coming, to become 0. How much will a project variable change for MPV to become 0? That's what sensitivity is measuring.
Brian, you said?
I said, by how much will a project change? That's the question that sensitivity is asking. So by how much will the project variable change for MPV to become 0? Okay, now, so our sensitivity to discount rate. Now, by how much will discount rate change? When I ask the question, by how much will discount rate change for MPV to become 0? What's the thing that pops in your mind? If I ask the question, by how much will discount rate change for MPV to become 0? What's the first thing that pops in your mind? Where have you heard something like this before?
Please say the question again.
I said, if I ask, by how much will discount rate change for MPV to become 0?
IRR.
Exactly. I've said this thing before, that this was a special class. And I say it again. I don't think I've ever had too many people say IRR at the same time.
Sorry, please, I didn't get you. Sorry.
Measures by how much our discount rate will change for NPV to become 0. That's what we said. That's what we've said before.
Okay, so what's the answer?
IRR. So our IRR measures is the measure of our sensitivity to discount rate. I'll explain this very soon. We'll see the whole idea of it will change. So if the discount rate changes to the IRR, NPV will become 0. If you think about it, if the discount rate changes to the IRR, NPV will become 0. That's what we said now. IRR is the discount rate at which NPV is 0.
Yes. Yeah,
right?
true. Yes.
So I will now measure our sensitivity. So if the discount rate changes to the IRR, if the discount, for example, if our IRR is 15% and our NPV and our current cost of capital is 10%. So if the cost of capital goes from 10% to 15%, then NPV will become 0. So that's so that means that the sensitivity now we can now, so we'll first of all measure the IRR, and then once we've gotten the IRR, if the rate moves to the IRR, NPV will become 0. So the difference between our current cost of capital and our IRR is the sensitivity to discount rate. Okay, now this will make a lot of sense. All of what we've written here will make a lot of sense once we do a question. So I'll just bring an arbitrary question, because I know that in the book there's no really, okay, we'll check. We'll also check, please. We'll just check for sensitivity questions. But please, let's remember that the values of the different project variables will be post-tax values. So it will be after tax. So for example, if present value of, so the present value one minus t. So instead of saying, for example, we can just say it directly. So instead of that, I'll say IE, present value of variable 1 minus t.